Yeah, I know the name sounds a bit formal, a bit complicated, right? But trust me, getting your head around this can literally save you money on your tax bill. So let's demystify this thing. Okay, so let's dive right in with a scenario you'll definitely recognize. Picture this. You buy a new van for deliveries or maybe a bunch of new laptops for the team. You know that stuff starts losing value the second you start using it. We call that depreciation in the books. But, and this is the frustrating part, when you go to file your taxes, you can't just tell the tax man, hey, my van is worth less, so take that off my profit. They don't accept it like that. So what do?
Well, this is where capital allowance comes in. You can think of it as the government's official version of depreciation. It's their system, their rules for recognizing that your assets get old and wear out. It's a tax relief that lets you deduct a slice of your assets' cost from your profits. And really, at the end of the day, it's all about one thing: helping you pay less tax. Simple as that.
All right, so how do we actually use this thing? It's not just one simple number. The best way to think about it is like a toolkit. You've got different tools for different jobs. So let's open it up and see what's inside. We're going to look at the three main types you'll be using.
First up, you've got your initial allowance. This is like a big upfront bonus you get to claim in the very first year you use an asset. Then you have the annual allowance. This is your steady, year-on-year claim that chips away at the asset's value over its lifetime. And then there's a cool little extra called the investment allowance. Think of it as a special reward from the government, but only for when you buy new plant and machinery.
Okay, so each of these has its own little quirks, its own rules. The big thing to get is that the initial and the investment allowances, they're one-and-done deals. You claim them once per asset, and that's it. It doesn't even matter when in the year you bought it. You get the full amount. But the annual allowance, that's your marathon runner. It's a recurring claim, and this one can be adjusted if you have a shorter than usual accounting period.
And this isn't just theory, right? These are real numbers that make a real difference. Check this out. You buy a new business vehicle, you get to claim a whopping 50% of its cost right away as an initial allowance, on top of a 25% annual allowance. Or what about office furniture and fittings? That's 25% up front and 20% every year. These are set government rates for the exact kinds of things your business is probably already buying. Now, you knew this was coming, right? With any kind of tax break, there are always rules. You can't just start claiming without ticking a few boxes first. The government has a pretty straightforward checklist, but you've got to make sure you can say yes to every single point. So, what's on this checklist? It's basically 3 common sense questions. Number 1, did you actually spend the money and get the asset? Simple enough. Number 2, are you using it for the business? Not for personal weekend trips. And number 3, was the asset still in use at the end of your financial year? If you can answer yes, yes, and yes, then you're in the game. Okay, now for probably the single biggest rule you need to remember. It's a major restriction, and it all boils down to this one simple fraction. So here's the deal. The government isn't going to let you use these allowances to bring your tax bill all the way down to 0 in one go. There's a limit. Your total claim for the year can't be more than 2/3, that's 66.7% of your assessable profit. But don't worry, anything you can't claim because of this cap isn't just gone forever. It gets carried forward and you can use it in the future. But, and this is a really important but, there's a huge exception to that 2/3 rule. If your business is in the agro-allied sector or in manufacturing, guess what? That rule doesn't apply to you. It's waived completely. You can claim 100% of your available capital allowance no matter what your profit is. It's a massive incentive the government put in place to really boost those key industries. Okay, let's shift gears a bit. There was a big change that came in with the Finance Act of 2019, and it adds another layer to this whole thing. This next rule isn't about what you buy, it's all about how much your company makes in a year. Basically, the Act splits companies into 3 buckets based on their annual turnover. At the bottom, you have small companies. That's if your turnover is 25 million naira or less. The big news for them, a 0% tax rate. In the middle, you've got medium companies making between 25 and 100 million. They pay 20%. And at the top, large companies, anyone bringing in 100 million or more, pay the full 30%. So what does this mean for those small companies? Well, the logic is pretty straightforward. If your tax rate is already 0, you can't claim capital allowances. It makes sense, right? You can't lower a tax bill that doesn't exist. This effectively means that this entire system we've been talking about is really designed for those medium and large businesses. All right, so we've gone through the types, the rules, the restrictions. So what's the point of all this? What's the big payoff at the end? Let's look at exactly how this hits your bottom line, where it really counts.
It's actually super simple when you see it side by side. On one hand, without capital allowances, you figure out your profit and boom, you pay tax on that whole amount. But on the other hand, with capital allowances, there's a crucial extra step. You take your profit and then you subtract your allowance claim. That gives you a new, lower taxable profit. And a lower profit means, you guessed it, a lower tax bill. It's a direct line from claim to cash saved.
And that really is the heart of it, isn't it? Understanding this stuff isn't just about ticking boxes for the tax office, it's a real strategic tool for your business. So I'll leave you with this thought. You bought your assets to help your business make money, but are they also working just as hard for you when it comes to tax time?